Good morning, everyone. Thanks so much for joining us here at Nelson Mullins as we're continuing a series of webinars about fintech and the impact it's having, particularly on chartered financial institutions and banks. Today, we're talking about what I think is a very relevant topic that we're getting a lot of questions from regulators regarding, and that is how banks are viewing their fintech deposits. And so, as we talk today, a few takeaways that you'll really want to focus upon is one, regulatory expectations are changing. As we go through today's CLE, you need to understand this has become an area of pretty significant focus for the prudential regulators. You've seen some very small banks that are playing in the fintech space. You now see a lot of the big banks that are playing in the fintech space. And I think a lot of what we're going to be talking about today is particularly relevant for smaller, say sub $10 billion in asset banks that are playing in the fintech space, but it really could apply to anybody who is working on partnerships and taking in these types of deposits. As we talk about broker deposits today, one of the challenges that you'll see is the regulators have been evolving in how they think about the broker deposit issue and how they think about fintech related deposits. And oftentimes it's up to the bankers to educate their regulators on these topics. And so one of the things we've been doing with a lot of our clients, and really the purpose of today's webinar, is to make sure that each of you who are participating understand a little bit about the history of broker deposits and how this issue came about. But more importantly, guidance that came out just a little bit over a year ago that changed how we treated broker deposits inside of banks. And then at the very end, we're going to talk about some of the latest challenges related to liquidity management and how regulators are viewing banks that have significant concentrations, if you will, or significant numbers of deposits. They're inside of these fintech partnerships or fintech relationships. Today, you can earn CLE credit for your attendance at this webinar. We'll be giving out 2 code words during the course of today's presentation, so listen for those. There'll also be a survey that's sent to you at the end of today's webinar. You'll have to fill that out and provide the 2 code words to claim your CLE credit. Also, there is a chat function that's available at any time. If you have questions, things that may not be making sense to you, feel free to reach out in the chat function, post that. We'll be trying to respond to those as we go along. Got a lot of folks joining now, and so I do want to introduce our speakers today. I'm Brad Rustin. I chair the financial regulatory practice here at Nelson Mullins. Nelson Mullins, just over 1,000-person law firm spread across the United States. But we have a very significant financial institutions group, very large practice that focuses on chartered and non-chartered financial services companies, so fintechs, money services businesses, lenders, and banks and credit unions. As we think about kind of where that has evolved over time, now about half of our clients are actually fintechs, specifically those who tend to partner with chartered FIs. Joining me today is one of my good friends and partners, Craig Nazaro, who's one of the leaders of our financial regulatory practice. He's in our Atlanta office, has been in-house with very, very large Big 5 banks, has served as chief compliance officer for $30 to $50 billion banks in the past. And then luckily, a number of years ago, he joined Nelson Mullins. This has been absolutely critical in the growth of our financial regulatory practice and spends most of his time focusing on fintech banking partnerships. Also joining me this morning is Mariana McDevitt, who's an associate in our Atlanta office. She also is distinguished in that she was a student of mine in my banking law class that I taught and survived that and is now working with banks all over the country on the implementation of their banking and fintech partnerships. And so with that slightly longer than I expected introduction, I'm going to kick it over to Craig, who's going to do some place setting, if you will, a little bit of background and how we start to think about broker deposits and how this issue has developed with fintech partnerships.
Thanks, Brad, or Professor Rustin. The next slide, the first one, the biggest takeaway from my perspective that I'd like everyone to walk away from this webinar is how are we thinking about broker deposits? When are we thinking about the questions? Are we integrating that analysis into any bank, fintech, bank payment partnership that we're building, that we're implementing? If they're already out there, have we gone through the analysis that's required of the broker deposit analysis and documenting that? And get ready to play defense during your supervisory examinations. We're starting to see in the last couple of years, Brad and I and the rest of the team has noticed that questions around broker deposit analysis has moved from almost non-existent. It was out there, but it was an afterthought in the exams to it's one of the leading questions when they get in there. And they're talking to your TPRM groups, and they're talking to your deposit ops groups. They're asking, where was the analysis done? How is it completed? Who's doing it? And I'd like to walk through that. So before we get into the rule, I wanted to just give a general overview. Up on your screen here, you see where broker deposits show up in bank fintech models, and it's really everywhere. It could be in the bank referrals, the fintech referrals, private label, SaaS solutions, bank to bank, every kind of fintech partnership that a bank can dip their toe into has the possibility of wading you into a broker deposit situation that you have to analyze and kind of take a position on. Next slide, Brad.
Well, and before we go there, Craig, one of the things that I think is kind of important here, which is there are a lot of banks that we speak to and we say, are you a fintech bank? And they say, no, we're not those kind of banks that are getting consent orders and are making the headlines of American Banker. Okay, well, look, yes, there are banks that have been featured in American Banker or may have entered into consent orders who are doing, full banking as a service, white labeled neo banking. There's all sorts of kind of both pejorative and common words for that type of relationship, but where a fintech tends to lead a banking partnership. But there are also a lot of banks, including some smaller community banks and smaller regional banks that are actually doing fintech relationships. Maybe, you're supporting CPAs that are doing electronic payments disbursements for clients, or you might be working with a company that's handling disbursements of funds and accounts payable assistance for a trucking company. Or maybe, you've got people who are doing active management of accounts for third parties. You're banking third party senders in the ACH structure. All of those carry with it the potential that those could be deemed broker deposits. And so you really need to be aware that any of those types of relationships where some third party is bringing to you large bulk deposits through indirect customers of the bank potentially is at play here, even if you're not doing banking as a service and are doing kind of the headline grabbing bank fintech partnership. Sorry, Craig, just wanted to kind of run that by folks.
No, not at all. It's a great point. And that kind of leads us into this next slide here, to know your products and services that are being offered through the partnerships. To Brad's point, not everything is a full-blown, BaaS solution, but when we see our banking clients get into trouble, it's, well, first of all, when our banking clients get into trouble, they retained us after they've gotten into the trouble. We generally steer them away from trouble. But what the questions lead to from the examiners in charge are, does the bank have a complete understanding of what products and what services are being offered? In the broker deposit space, that comes down to, have you thought about it before the EIC has asked this question? And do you have a good understanding of what the functionality is, what the guardrails are within these partnerships? Is it defined in the documentation? Has it run through a committee? And this is where we start asking the questions like, how are your fintech partnerships governed? If you're on the bank side, does your bank have a defined risk threshold? Is the board aware of the risks associated with each partnership? Has the senior management teams or any fintech committee or partnership banking committee contemplated the risks involved within these partnerships? And in that contemplation, is the broker deposit analysis thought of and addressed? Even if you come down on the wrong side, or your regulator disagrees with your analysis, having done that analysis is going to get you a long way in defending your position, in walking away from any findings. It should be defined within a policy that's out there of when it'll be completed, the broker deposits analysis will be completed, what kind of operational functionality and revenue sharing are you willing to go out to the market with? And we'll see as we go through the rule how those decisions can start to impact the designation of your partners as a deposit broker. Often banks are caught flat-footed when asked about the broker deposits within their exams, and that's the primary reason we want to start to have this contemplation done ahead of time. We want to make sure that the right people have been discussing it. The bank is aware of the risks that come along with broker deposits, and the last thing you want to have to do is go back and restate your call reports or restate what percentage of your deposits are actually broker deposits. Next slide, Brad.
Yeah, and to your point, Craig, we had that early on when the FDIC, prior to the modern broker deposit rule, and it was somewhat alarming for a bank that had called us and said, hey, their regulator was looking at a series of fintech-related deposits and was potentially asking them to restate almost 18 months of call reports to reclassify certain things as brokered deposits that they had not classified as brokered deposits because their accounting firm, I don't know, was aware of this particular issue. And so, if you really want to make a board and management team panic, just have a regulator start talking about 18 months of restating call reports.
Exactly. So, and that's why at the beginning of this, we want to talk about, how do you even address this before you get into the analysis under the rule? Where are you starting to build out these controls to make sure you're capturing the risks, addressing the risk, and documenting it for your regulators? A lot of the times from the fintech's position, they don't care one way or the other, or even are aware, depending on how mature the fintech is, as to the impact of the classification between core deposits and broker deposits for a bank. It's just not in their business model. They're not generally thinking about it. Both should be asking before you even enter into the agreements for the MSAs which are going to govern your partnership, about core tenets within the relationship. Is the relationship exclusive to the bank? Is the fintech tied to your bank for any given amount of time? If it's not exclusive, are we mandating that it's exclusive until we can obtain one of the exceptions that we'll talk about later in the rule? Does the MSA outline the bank's need for deposits to be classified as core deposits? Have we had those discussions with the partners around the economics of the deal if it's not a core deposit for the bank, and how those economics can be impacted by the classification? Because having the bank's deposits be classified as bank deposits isn't necessarily a regulatory issue right off the bat. The misclassification of the deposits creates problematic narrative with the regulator as you're going through your exams. It can indicate problems with your internal compliance management system, your controls, the line of sight by senior management and board oversight into the fintech partnerships, and that might be an indicator in the regulator's eyes that you as a licensed financial institution weren't ready for these partnerships if you didn't have these conversations, if you didn't document the responsibilities within the MSA. So before you start even thinking about the broker deposit individual analysis, it really is a core tenet of your fintech partnership group or your fintech partnership line of business, meaning that it should be built into the initial due diligence of prospective partners and when it's brought to the bank, or even have that conversation within the bank and create mandates as what the senior management and the board is going to be expecting of these partnerships. And I think with that slide, we're going to actually start to delve into the rule. And Mariana, you have the first slide about the general overview.
Before we do that, Mariana, the first code word for everyone is brokered. And we'll give these to you at the end again, but yes, there'll be two code words today. The first of those code words, the first of the two that you'll have to input to claim CLE credit, is the word brokered. Sorry, Mariana, didn't mean to interrupt you there, but wanted to get that out for our audience here.
No worries, that's what we're here for. Before we go deeper into applicability, just a quick overview of the rule. So the FDIC issued this rule December 2020, and it went into effect April 2021. Essentially, the FDIC realized there have just been significant changes to the banking industry, to technological developments and new business relationships and arrangements. So they issued this rule just to better reflect the current needs of the marketplace. And ultimately, it tries to promote bank fintech relationships by narrowing the range of deposits that can be deemed as brokered deposits, which really allows banks and fintechs to offer a larger variety of products to consumers and really increase access to financial services. Do the next slide.
Yeah, Mariana, one of the things too, I guess to just kind of contextualize for some of those who played in the space pre-2021, there was no clean definitions of what was and was not a brokered deposit. Back in the day, it was somewhat discretionary. You were having one-on-ones with the FDIC to discuss it. You were constantly debating the FDIC about the stickiness of deposits and rights to move the deposits quickly out of the bank, things of that sort. And so, it really was a challenge to kind of know what was and was not considered a broker deposit, especially if you were a bank that was in troubled condition that could not add broker deposits to your asset mix or to your liability mix. Because you didn't know exactly what was in and what was out. And so just like you said, Mariana, the whole idea here was to hopefully provide a framework, give some structure so that, at least to a certain extent, we know what was in and what was out.
Thank you. So the definition of deposit broker. The FDIC's rule defines deposit broker as any person engaged in the business of placing deposits or facilitating the placement of deposits of third parties with insured depository institutions, or the business of placing deposits with insured depository institutions for the purpose of selling interest in those deposits to third parties. So the FDIC considers a person to be engaged in the business of placing deposits if that person receives third-party funds and deposits those funds at more than one IDI. And a person is considered to be engaged in the business of facilitation when one or more of the below is present. So whether the person has legal authority, contractual, or otherwise to close the account or move the third party's funds to another IDI, or they're involved in setting rates, fees, terms, or conditions for the deposit account. The rule also provides 10 exceptions to the definition, including the primary purpose exception, which Brad and Craig will go into further detail in. Oh, sorry, next slide. Some of the statutory exceptions that the rule provides are listed below, but it's property management services, cross-border clearing services, real estate-related transactions, residential, commercial, escrow, like-kind exchanges, broker-dealer funds, and special reserve accounts, futures, deposit placed that required collateral for credit card loans. We have deposits placed to pay or to reimburse qualified medical expenses, deposits placed for qualified tuition programs, deposits for retirement accounts, and deposits placed by agencies to disperse government benefits.
And so we'll go into one issue before we get into some of the exceptions to the definition or the classification of deposits as brokered. And I've got to admit, credit where credit is due. Our fins at FinPro first alerted us to this issue because they started getting questions from the FDIC. And this is, truly last 4 weeks types of questions. And so credit to Don Musso and his team who flagged this for us as we're working together on a bank that's doing fintech partnerships. But one of the things we did want to draw your attention to is somewhat quietly, the FDIC revised section 6.1 of the FDIC manual that deals with liquidity and funds management. And the language that you see on your screen is the definition of what's called wholesale funds. If you think about what wholesale funds are, it's a series of guidances to examiners that say that examiners need to look at how the bank is managing non-retail funding sources. And so obviously, if you think about kind of the way the world splits, when we get deposits into our bank, we either have retail deposits, people who we have farmed placing money with the bank, either insured or uninsured, but just deposits. Or we have wholesale deposits, meaning they are coming through some third-party source. And what was interesting is the old definition of wholesale funds defined them as brokered deposits. Okay, makes sense, right? If we are going out and we're doing old-fashioned deposit brokering, I'm going to another depository. I'm saying, hey, I need, $100 million of broker deposits. I need to bump up my deposit side of the balance sheet, and we're sourcing those from another institution. Okay, fair enough. What changed is they added this definition to wholesale funding to say it includes deposits obtained through programs marketed by third parties, such as, and here's the key kicker here, a financial technology firm, even though not reported as brokered deposits. Okay, now what that means is, the net effect of this is, if you have these types of fintech relationships, even if it's not a broker deposit, your board and your management team need to be looking at these because they could be potential wholesale funds, and you need an affirmative program to manage liquidity associated with that, right? Because where wholesale funds play in to the FDIC manual is it deals with liquidity management, right? Meaning what would happen if suddenly these funds left your institution, right? Because we assume retail funds are sticky, right? Meaning not everybody's going to close their checking account all on the same day absent some sort of bank run. But what the FDIC did by changing this section of the exam manual to say, look, even if it's not a brokered deposit under the broker deposit rule, they are still somehow a riskier type of deposit than your typical retail checking account or retail DDAs or retail savings accounts. And so what they say is you need to have this as part of your liquidity management plan. And now the FDIC in particular has started to ask this question of banks, right? Because here's the requirements, right? If you have wholesale funds, you must be analyzing how you are going to maintain liquidity in the event those wholesale funds were to leave your institution, right? How would these non-traditional funding sources impact the liquidity position of your bank? So even assuming you go through the analysis, you look at this presentation, you do your internal analysis with your counsel and your compliance officer and say, look, these are not the broker deposits. Still understand you need to be looking at these in this special way to understand that these could be deemed wholesale sources of funds. And you need to be accounting for that in your liquidity plans that are being approved by your board and being developed by management, right? What would happen if suddenly these fintech related deposits were to leave your institution? How this plays out over the next 6 months, we've been working with the FDIC and the OCC and the Fed trying to get further insight on some of these changes, what they think the impact is going to be. The folks at FinPro who first flagged this to us have been having ongoing discussions with the regulators. A number of our banks are having these discussions. And so in essence, stay tuned. We'll let you know kind of what the practical impact of this is. Certainly we know right now it is, make sure you understand these could be wholesale, make sure you're taking account of it in your liquidity management plans.
It does track, Brad, just like some of the questions we've seen in the exams, even when we have the proper broker deposit analysis completed and we have the arguments as to why we're treating them as core deposits in line and in place, you will sometimes get questions about how you're leveraging those deposits within the exam. Like, how are we so confident in that they are as sticky as our true core deposits? Which is not a question to get, because under the broker deposit regs, if the analysis is done correctly, they are core deposits. But I think this might be where this change is coming from, where you're starting to see the regulators push back a little bit, because they're worried about, a large scale shifting of your deposits if they move overnight, which is another narrative of the conversations we're having with regulators within these exams. Sometimes the teams, the examinations, take a position that all of these partnership funds are extremely portable and you can move them very quickly, and they don't have an appreciation for the amount of time and effort it takes to stand these relationships up. This is not something that you can just port over like a traditional broker deposit that you can move on a nightly, weekly basis. From the fintech side, and we'll talk about exclusivity with this later, we'll talk about how this impacts exclusivity rights. But fintechs, it's not an easy, lift to just pull up and move these deposits to another bank, and that's sometimes lost on the examination teams. And I think this is where this is coming from.
Yeah, and I want to run back real quick and kind of touch on something that Mariana had brought up, which is, at the end of the day, the whole purpose of these rules is to try to codify, to actually implement in the regulations what accounts are sticky and what accounts are not sticky, right? Because if you think about where the FDIC is coming from with this, right, we have the DIF, the Deposit Insurance Fund, that's funded up with a little micro amount of funds. At one point, I think it was 0.3% of the total deposits in the U.S. And so, obviously the FDIC, just like all of us as bankers, does not fully reserve for all of its losses, right? Meaning if every bank suddenly had every account go to zero and the FDIC had to insure it, there's, 1,000 times underfunding in terms of the Deposit Insurance Fund. But the concern here is, in the event that large numbers of deposits are pulled out of a bank and you have bank failures, right, where the DIF would have to pick up and look, I mean, a lot of these are kind of in the context of some of these kind of high profile fintech banking partnership failures, right, where the FDIC had to step in and use the Deposit Insurance Fund and then go to the Treasury to actually get funding to make depositors whole. And so the whole idea here is what counts as a sticky deposit, right? And at the top of our stickiness is time deposits, right? So CDs, other things that are time-based. Below that, you have limited withdrawal rights accounts, savings accounts, that are restricted to 6 withdrawals per month. Below that, you have retail checking. And then you start getting into less and less sticky, all the way down to brokered deposits, which we assume could be pulled out by the broker under certain circumstances, right? If they don't like the bank, they don't like what the bank is doing, then suddenly those funds could be yanked back out of the bank. And so what we're trying to do with the deposit broker rules is set up a hierarchy and say, okay, there are certain circumstances where the bank didn't organically source accounts, right? We didn't go out, put up a billboard, and Mr. or Mrs. Smith didn't walk in and open an account with us. But these could be sticky in the way that those deposit accounts that we organically sourced would have been. And so there's a whole series of statutory exceptions that you see on your screen right now that potentially apply and say, look, these are not broker deposits because statutorily, we as the FDIC say these are sticky deposits, they're good to go. And Mariana, do you want to kind of run through a few of the key ones here and talk through us with some of these statutory exceptions?
Yeah, thank you. So the ones that I was discussing earlier were the designated business exceptions, but beyond that, we have the insured deposit, like the IDI exception. We have an employee of an IDI with respect to funds placed with the employing IDI. We have a trust department of an IDI if the trust or other fiduciary relationship in question has been established for the primary purpose of placing funds with the IDI. The trustee of a pension or other employee benefit plan, a person acting as a plan administrator or an investment advisor, a trustee of a testamentary account, the trustee of an irrevocable trust. We also have trustee or custodian of a pension or profit sharing plan, and an agent or nominee whose primary purpose is not the placement of funds with depository institutions, which I have found to be very common right now.
Yeah. And so what we're going to do is we're going to go in and start to take a dive on perhaps one of the most relevant of these exceptions to fintech partnerships, and that is this concept of primary purpose. And so again, remember, context, we're trying to figure out when deposits are sticky. And at the end of the day, what the FDIC is perhaps most worried about when we talk about broker deposits is people who are rate shopping, right? What is the quintessential broker deposit? Is some broker comes and says, hi, I spoke to XYZ Bank. XYZ Bank is paying 4.75% APY right now on an account, high yield savings account. You need to go to Bank XYZ. And the FDIC's concern is obviously, well, what happens 15, 20 days from now when bank ABC is offering 4.85% APY? What's going to happen to that money? And, clearly their concern is people would then pull the money out and go to another institution, right? Not a sticky deposit, because all we're doing, we don't care about XYZ Bank. We're just shopping for what the highest rate is for our customer that we as the deposit brokers are engaged in. And what the primary purpose exception says is there are certain types of relationships, particularly in the fintech space, where the purpose of developing the account at XYZ Bank is not really for the placement of funds, right? We're not shopping for a place to warehouse money and get yield. Instead, it's designed to facilitate the movement of money, payments, some other purpose that the fintech is marketing. It's like, let's take the quintessential example, which is, one of the big payments companies, right? The whole reason you open a PayPal account is probably not because PayPal is paying you a high yield on that money that you keep at PayPal. I don't know the terms of the PayPal account. I don't think they pay APY, but let's assume they don't for purposes of my example here. The whole reason you opened a PayPal account is so that you can move money to Aunt Sue, who you need to pay for your half of dinner last Wednesday, right? So the purpose of that relationship with XYZ Bank is not because XYZ Bank was offering you some sort of competitive term, competitive yield, and the second they drop the APY, you say, look, I'm tired of XYZ Bank, they're not paying me enough, right? You're using the money in that bank because you want to use the service, PayPal, right? So the primary purpose is to, quote, enable transactions, right? The second part of this primary purpose exception, right? The whole reason you're keeping money there, the whole reason XYZ Bank is involved is to move money. The other is really kind of more for broker dealers or custodial investment advisors, custodial RIAs, and that is it could be the case that that particular broker dealer or IA, or technically could be a company who could legally custody money, places less than 25% of the funds that it manages with your particular insured depository institution. One question we actually get, and we'll talk about this a little bit in the exclusivity exemption, but when we use the word IDI, that is a term of art in this statute. It means an FDIC insured institution. You say, Rustin, why does that matter? The real reason why this matters is kind of twofold. One, if there is relationships with a credit union, an NCUA insured, share insurance fund insured depository, FDIC is taking the position that's not an insured depository institution. Also, if it is one of those, not very common, but they exist, privately insured banks, it is not an FDIC insured depository institution. So when we use the word IDI throughout today's presentation, know that we're using that as a term of art, meaning an FDIC insured bank depository institution. When we talk about the enabling transactions rule, where this comes up is you actually have to take another step, right? It's not an automatic get out of jail free card, right? If the regulators ask, these are all enabling transactions, wash my hands, don't think about it again. Instead, what we have to do is file a notice filing anytime we're using one of these primary purpose exemptions. And there's actually a form that you fill out with the FDIC. It goes to your region, and you have to provide them with notice. And it asks questions about what the nature of that fintech relationship is, right? If you're applying under the 25% rule, it says, who is this company you're working with? How do you know they're only putting 25% or less of their deposits with you, et cetera? And then secondarily, if you're doing it under the enabling transactions test, you have to provide evidence and documentation related to how it is truly enabling transactions, right? They'll ask you, show us the terms that this fintech payments company, the digital wallet, provides to their customers. Show us their marketing, right? Is it referencing yield? Is it referencing competitiveness with other banks? Or is it truly, this is a digital wallet you're signing up for a digital wallet because you want to move money to your friend, or, you know, in my earlier example, Aunt Sue to take your half of the dinner split. If that's the case, then you got to answer those questions, put that notice filing on file with the FDIC. Now, we did talk, the primary purpose exception does have kind of a, what I would call a catch-all, which is if it's not one of the designated exceptions, you can still make an argument that this is a sticky deposit and the purpose of the account is not the placement of deposits and the obtaining of yield on the account. And so we've had one bank that actually went through this. We ended up restructuring it in a way so we didn't have to go down this route. But you can ask for a discretionary, you know, kind of catch-all to the FDIC and say, look, this is functionally equivalent to one of these primary purpose exemptions that you've articulated. And then you have to get approval from the FDIC. It's discretionary. It's not one of these more, what I would call, automatic. When we talk about business relationships under the primary purpose exception, what have they typically classified? You know, this is what Mariana was referencing earlier, which is, you know, there are certain types of relationships that the FDIC says, look, banks commonly engage in these things. And there's really no reason that you should have to go through a discretionary exemption or provide us with notice, right? And so it's like the one she was mentioning, like a property management firm. Right, if you've got a property management firm, they are renting out beach houses on the California coast, and they're taking in large amounts of money. And the whole purpose of that is renters have to pay money, and then they hold the money and then they disperse it to the homeowners whose programs are in, who are then, you know, receiving the money from the rentals. Okay, they're not shopping around banks because of yield. The homeowners aren't going to get upset and move the accounts, right? They are truly doing this because ABC Beach Rentals Company is providing a service to these homeowners and to the renters. You know, same thing with like cross-border clearing, mortgage servicing. You know, those tend to be relationships where the purpose of the account is some sort of defined thing, and you don't care who's holding the money, right? If I'm renting out my beach house, I don't really care what bank is actually holding the money in transit to me. I mean, maybe some of you do, but that's not the reason why I got ABC Beach Rental Company. I got ABC Beach Rental Company because they're a really good beach house renter. You know, same thing if I'm doing cross-border transactions, right? If I'm using Western Union, I'm using Western Union because they can send money to my family, you know, that may be overseas, right? I'm not caring what bank Western Union uses on the back end. Same thing with, you know, governmental agencies, things of that sort, you know, or, you know, IRS related transactions where you're doing like swaps and things of that sort, right? You're buying a service, you don't really care what the bank is on the back end. Craig, Mariana, any thoughts on those before I jump forward?
That's
okay.
Good.
You know, as we mentioned, when we talk about the primary purpose exemption, you know, most of them are notice filings, right? You've got to go on record, fill out the information, put it on file with the FDIC, unless you're applying for one of those discretionary exemptions where you actually have to make an application, have it approved. But just know, and you know, this should be things you're collecting in diligence with your partners, but you're going to have to provide information on the fintech partner, right? You're going to have to provide information on their name, how they operate, some sort of contractual evidence, both your agreement with the fintech's agreement with the end users. Sometimes they'll ask for, you know, certainly a description of the product. Some of these ask for, you know, examples of how it's marketed to the public. Because, you know, that's obviously how the FDIC is going to evaluate this. But there's no sort of waiting period, right? You file, as long as you can make the notice exception, you file the notice. Once you have the notice on file, it gets acknowledged as received by the FDIC, and then you go forward with it, right? You satisfied your obligation unless you're applying for like one of the discretionary applications. Fairly easy process. One question we always get asked is both the fintech and the bank can file this application or this notice. forgive me for all the fintech folks who are on the call here today. As someone who represents banks, I don't ever want the fintech going to my regulators and telling my regulators what they view we're doing as a bank and a fintech partner. Instead, generally, the banks want to control that narrative and file that application. We've actually now been working with a lot of our fintech sponsor banks, and they will make the fintech contractually agree to cooperate in these processes, right? We've got to work together to get these on file. The bank's going to file it with the FDIC, but we want you to work with us in putting this information together, and that seems to work pretty well.
The only thing I would add there, Brad, if the fintech were to file the notice, on the bank side, just remember that if there's any communication back from the FDIC as to like an objection or follow-up questions, the bank needs to be made aware of that, and it should be built into the MSAs that further communication would be escalated back up to the bank, because the bank can rely on that notice filing that like Brad was saying, when you put that, when you get that response email that the notice has been filed, the bank can rely upon that so long as it was done in good faith, but it must stop relying on it when the FDIC comes back with any questions or removes you from the exception itself.
Yeah, really good point there, Craig. Now, one of the issues we see that develops a lot is if you look at the primary purpose exception, it says enabling transactions, and it generally excludes yield producing accounts. We get a lot of questions from banks where they are offering both a transactional account, a digital wallet, and electronic payment solution, as well as a savings account or a yield producing account, or there is some amount of yield being paid to the customer, to the end user through the account. Generally, unless another exception applies, you would have to file an application as opposed to a notice for those types of accounts, right? Because the notice only is enabling transactions, purpose of facilitating transactions, no yield is paid. Here, if you're paying yield, it is still potentially possible to apply and obtain an exemption from the FDIC, but you have to apply for it. And generally, the linchpin of those applications is when we file it, we say, look, we're paying a sub-market APY. Right, we're giving people, 50 basis points, 100 basis points on that APY right now. And our argument is, look, if they were shopping for rates, they wouldn't go somewhere that's paying 50 basis points, right? 0.5% APY right now. So clearly the reason they're using this is they like the digital wallet. We just happen to also give them yield on that money. Okay, that argument is fairly reasonable. FDIC has been responsive to it, but just understand that when you start talking about fintech relationships where you are paying yield to the users, you've walked yourself out of kind of the easy path, unless another exception applies. And now you're getting into discretionary FDIC application path that may be significantly more difficult for you to address. One other that we'll talk about, and then I'm going to kick it back over to Craig with our next code word, is there is another just automatic blanket exclusion. It's what a lot of banks use. And that is if the fintech only has an exclusive relationship with your bank, not a broker deposit, setting aside that wholesale funding issue, right? The only bank they work with, all of that fintech's relationship is with your bank, not a broker deposit, definitionally not a broker deposit. And so, a lot of banks now are saying, look, you have to be exclusive. Well, in the wake of SVB and some of these other failures, guess what makes fintechs very nervous? Is exclusive relationships with a single bank. So there's a huge tension going on right now between the two sides of this equation. Because the fintechs, the last thing they want is exclusivity. I'm going to put all my beans in this one something. I'm going to enter in. Yeah, I forgot the metaphor there. I'm going to, exclusively work with this one bank, and if they decide they don't like my partnership, they want to get out of the fintech business, I am in a very difficult position because I don't have the ability to dual track and fail onto another bank. And one of the things the regulators are looking for with these exclusivity is both an obligation in your contracts in the MSA to have exclusivity, right? You're agreeing this is exclusive. But then secondarily, they also want to see that you are actually monitoring for that exclusivity, right? You can't just say, well, we told them they had to be exclusive. They're going to expect that your compliance department in your bank is doing some sort of follow-up, some sort of diligence on an ongoing basis to make sure that at the bottom of the little web page for the fintech, it doesn't say deposit accounts held at 1, 2, 3, 4, 5 FDIC insured banks, because now you don't have that exclusivity relationship. Craig, any thoughts on that?
Yeah, the one thing I would add there is that the exclusivity is, while we like to see it defined, if that's what you're relying on within the underlying MSA, it doesn't have to be defined. If you're monitoring for it and they are exclusive currently, like if you're setting up, if you have a fintech that's not that mature, that's maybe going through building up or getting to, they may want to be able to get, bank B partner, bank C partner, but they may not have it yet. Just because they're looking to break that exclusivity at some point in the future doesn't mean that you can't claim the exclusivity clause currently. If they're exclusive to your bank, even if the MSA doesn't say it, you can leverage this carve out. It's just a little dicey in the fact that what does the monitoring look like? How are you positive that the exclusivity is intact? Those questions will be asked within your exam if you don't have it explicitly stated within the MSA.
And remember, there again, it is exclusive to an insured depository institution, which is an FDIC insured depository institution. The other thing that is kind of worth noting on the exclusivity piece that has come up is in the FAQs related to the broker deposit rules, we get a lot of questions, which is, hey, there's Conglommo Fintech. We're the only people who do their high yield account. That other bank does their digital wallet account. Can we claim exclusivity? Unfortunately, in the FAQs associated with the broker deposit rules, they foreclosed that and they said all related parties to the fintech are analyzed when determining exclusivity. So you can't kind of cut and slice up a fintech and say, okay, we're exclusive as to this, that bank's exclusive as to product B, bank C is exclusive as to product D, right? We can't slice and dice a fintech. All of them have to be aggregated. Craig, I'm gonna kick it over to you, but before we do, we'll give a second code word for today's presentation, and that is, surprisingly, deposits. So the two code words for today are brokered, B-R-O-K-E-R-E-D, and deposits, D-E-P-O-S-I-T-S. And so when you get your survey after today's presentation, you'll need to fill out the survey and then submit those two code words, brokered and deposits, in order to claim your CLE credit. So Craig, I'll kick it over to you.
Thanks, Brad. I do want to leave a couple of minutes for any questions that we have, but I want to go over and kind of tie it up on the back end from the supervision concerns. Now that we've walked through the rules, the exclusivity carve-outs, the primary purpose exemptions, you can see how the structuring of the deal and the oversight of the deal becomes very at the forefront of your compliance with broker deposit treatment. So when you get into your exams, like we were saying earlier in the webinar, it's one of the first questions that you'll receive is, what is your treatment of these deposits as broker deposits? How are you doing that analysis? Are you doing it in a general treatment for all your partnerships, or are you, taking a more granular approach and doing the analysis on each individual partnership? Unsurprisingly, the regulators like to see that granular approach and have that analysis done on each individual partnership that you're doing, which can become quite a lift if you're, partnering with a significant number of fintechs. But you should be prepared to answer the question of what does that analysis process look like around broker deposits? When is it being completed? Who is it being escalated to? Where are you housing that analysis? How often is this analysis being completed? To Brad's point, like say you're leveraging the exclusivity carve out, how are you confirming that exclusivity? Is it within an annual certification from the fintech? Is it something that's built into your TPRM process? Is compliance monitoring and testing for it? You want just like everything else in fintech partnerships, you want the core controls of the bank to be deployed over your fintech line of business as well. Part of that deployment is, monitoring for any treatment under broker deposit analysis, and how you're monitoring it and looking for any material changes. One more slide, Brad, I think.
Yep, gotcha.
Okay. If you're going to treat your deposits in your fintech partnerships as broker deposits, now what do you do? So within your exams, it's going to be treated just like any other fintech partnerships. Just know that even if you're treating them as broker deposits, this is not going to relieve you of your oversight obligations when it comes to identifying that individual depositor. Every regulator is going to want to see that you have a bare minimum, established minimum CDD procedures for all deposit brokers. Testing or what's being collected, the identity verification processes, who those individual deposit brokers are servicing, who those end users are, whose funds are actually sitting in your bank. That's all going to be still required, even if you go down the route of classifying the partner as a broker deposit. The same thing, the BSA AML risk on the next slide, Brad. Again, more just to the point, what are you doing internally? How is your CMS, specifically your BSA AML policy and your BSA AML oversight of your partners? How are they being deployed? This really should not change from your general fintech partnership oversight, but it's just it's asked in a more direct manner if you're going to classify the partners as deposit brokers. With that, I did want to leave a few minutes for questions and answers, unless anyone has any specific points that were missed. Brad, Mariana, anything that we didn't catch there?
Yeah, Craig, somebody asked, is market right now to expect exclusivity in fintech partnerships? Any feel for that?
Yeah, no, not at all. It might have been, as Brad was saying, years ago when banks were starting to stand these partnerships up at scale. Now, with especially post SVB, every fintech out there wants the ability to pick up and move if one bank changes its risk tolerance. And from the fintech perspective, if you're the bank in these partnerships, you got to remember, from the fintech's point of view, you're going through all this diligence, you're setting it up. The irony is not lost that it's impossible to stand up these partnerships very quickly, especially if a bank decides to shut down the partnership. So all the fintechs, to make sure they have the ability to stay alive, if their primary partner decides to exit that particular line of business or exit servicing customers that fintech may have as their primary customer, they want the ability to fight to live another day, so they can only do that if they have more than one bank. At times it's multiple banks, bank 2, bank 3, bank 4. Especially when they get to scale, it's almost never going to be exclusive if you're at scale. And remember, within the MSAs, the bank is always, it's not market for the bank to have any language in the MSA stating that there's an extended termination or wind down period. A bank must retain the right, satisfy their regulators that, hey, look, if we determine this business to be too risky, or if we determine that, we're not properly staffed to have significant oversight of this partnership, we need the ability to shut this down. With the banks retaining that right to shut it down, or we call it a God clause, like the ability to back out of these partnerships at any given time, the fintech rightfully asks for the ability to have multiple sources to plug their product into, to avoid the risk of a bank just, not haphazardly, but choosing to exit a particular space rather quickly, which can be fatal to a fintech.
And Craig, another one, and I'll pose it to you, and I may jump in after you open up on it, which is, how are regulators viewing fintech partnerships now? Has it changed over the last 6 months?
Yeah, it's constantly changing. I would say that as you can see these consent orders rolling out over the last 12, 24 months, there's a consistent theme. It's oversight, escalation, and line of sight from board, from senior management into these partnerships. A definition of what the risk tolerance is of the particular bank, in the fintech partnerships. And that's what we were talking about at the outset of this call, where we want to have the subject matter expertise. We want to showcase to our regulator that we understand all the risks associated with these partnerships, including the risks associated with broker deposits and the analysis that's required and the treatment that's required of the funds that you have on deposits to these partnerships. But the questions are becoming more and more granular from a regulatory standpoint. They want to see that you truly do have the subject matter expertise, that you're not just diving into partnerships where you may not be well versed, where you're taking on any partnership that's out there that can possibly generate revenue. They want to see a risk reward analysis. They want to see the governing controls that are implemented across the core bank, implemented within the fintech partnerships. And the regulators are getting very concerned over what is being communicated to the individual end users. Does the individual end user believe that they have pass-through FDIC insurance? Or do they believe that they are protected in the event that the fintech declares bankruptcy, but the bank is ongoing? And all these issues are being addressed in the exams in real time. And even as the regulators become more and more educated as to the products that are available out there for fintechs, the regulators are adopting examination methodology to match. Brad, do you want to add anything?
Yeah, I'll just add briefly. I think, the level of sophistication right now has significantly increased at the OCC, FDIC, and Fed. And with that is coming an expectation that the bank sophistication has to similarly go up pretty dramatically. And what I mean by that is, just like Craig is saying, they're going to come in and they're going to ask your head of fintech or somebody in deposit ops, okay, show me the broker deposit analysis for ABC Co, this partner that you're operating. And you better be able to navigate through this pretty effectively and kind of chart your path as to why it is or is not a broker deposit and how you treated it and why that matters, and understand the import of that analysis. Because the regulators are picking up on this and are now explaining that. And what that means is, I think, an often used quote that I'll throw out there is, the moat is getting wider, right? It is now much harder to be a fintech sponsor bank, but the moat also got wider. And if you do this well, economics are much better for banks right now. The number of banks doing it is shrinking. You see the big guys starting to play in the space because it is highly profitable for the bank that is doing these fintech partnerships. And if you're willing to invest in it, it can actually make a lot of sense to do that. Let's see, Craig, another question that came in our last couple minutes here. What about antitrust concerns related to exclusivity? You want to take that one, or you want me to?
My initial reaction was that the banking regulators have no antitrust concerns around the exclusivity, because we're not setting a market rate or keeping the customer trapped in there. We're protecting the liquidity of the bank in and of itself. We don't want to see those deposits run outside, so that's their main focus. They're not focused on the competitive nature of what's being offered to the end consumer. It's not viewed through that lens. I don't know if you disagree, Rob.
Yeah, no, I mean, I think that's certainly the bank regulator view, is exclusivity is a liquidity protection device, as opposed to necessarily, look, I mean, I think it's a fair question from the folks who raised that, which is, could that be harmful to the consumer if, the fintech can't effectively change banks? Yes, there probably is some potential harm there to the consumer that should be taken into account by the fintech. Where we've seen a lot of the focus instead is when you get multiple banks and they are working together to set pricing and to share pricing information. I think one of this, to a nuance perhaps here too, is the fintech could always change banks. You just can't have more than one. Right? It's almost like, the high school date. You can have a girlfriend or boyfriend with you. You just can't have more than one. And if you don't like that one, you can change to a new one. Okay, that's fair. But you can't have more than one at one time, to use that exclusivity exemption. And so I think you're right, though. You need to be really careful with how you structure these, that it's not, I set pricing and you're set forever and you can't move. because I think, you know, the person who raised this question, you could start crossing over into a line you probably don't want to deal with as a bank or a fintech into, you know, are you taking anti-competitive measures to restrict consumer choice? I think that is a very fair question there.
The only thing I'd add there, Brad, is the FDIC's purpose too, or some of the stated purpose when they rolled these rules out, is that they wanted to make sure that people had greater access to banking services. So like even if you're relying on the exclusivity provision, the FDIC's point of view is that it's providing greater access to people that may not have had traditional banking services because of, you know, these fintech partnerships and the ubiquitousness of the products that are out there that weren't traditionally offered through banks in and of itself, even if it is exclusive to one bank.
So that brings us to the top of the hour. We always try to end on time with these webinars. Thank you so much for joining us. Again, you'll be getting a survey you'll need to fill out, two passwords, brokered and deposits that you will need to send back in there. Our contact information is in the deck that will circulate to everyone. You're welcome to reach out to any of us at any time. Happy to try to field questions. Really appreciate you joining us as we continue this FinTech and FinTech banking webinar series. We'll keep you apprised of those that are coming up, but appreciate everyone's attendance today and hope you enjoyed it. Welcome any feedback that you may have. Super huge thanks to Mariana and Craig for all of their work on this presentation, making it amazing, and appreciate you for joining us. We'll be in touch with future webinars. Thanks, everybody.
Thanks, guys. Okay.